2012 also was a transitional year for Bank of Ireland, and 2013 will be as well. Our allowance for loan losses declined last year from the level in 2011, and the second half of 2012 was lower than the first half. We expect this trend to continue during 2013 and 2014. Very few mortgages are actually foreclosed in Ireland. Typically are modified, and happily 86% of Bank of Ireland's previously modified mortgages are performing in line with their new terms. The revisions usually involve partial forgiveness and/or capitalization of arrearages, and often a reduction in the amount of annual principal amortization. Outright forgiveness of principal is very rare. This is because a homeowner cannot escape from a mortgage deficiency, even in bankruptcy, simply by giving back the keys. The deficiency judgment will remain as a personal liability for 3 years. Until recently, the claim lasted for 12 years. A new bankruptcy regime has recently been introduced that will make it easier to deal with unsecured debt, such as credit cards, that an underwater borrower owes. Bank of Ireland has loss reserves equal to 47% of the amount of mortgage arrearages. The original loan-to-value ratios were pretty conservative, so these reserves are probably adequate even if values were to decline another 10% or so. And more than all of Bank's 2012 total losses were due to loan loss provisions and other one-time special items. Reducing provisioning to levels closer to normal ones is essential to the bank's regaining profitability. The bank unfortunately had to lay off 1,286 people last year, mostly not until the second half, because we had fairly protracted negotiations with both the unions and the government. Another 1,200 will have to be released this year, so 2014 will be the first year when the full reductions will be effective with no offsetting severance payments. That's a savings of about 125 million euros a year. Tracker mortgages, whose variable rate is set at a premium over the European Central Bank's lowest rate, will remain a problem as long as ECB continues its artificially low rates. Trackers represent 62% of Bank of Ireland's mortgage book and 24% of our total loans. These trackers mean that when normal interest rates return, the bank's earnings will be hugely enhanced. Each 100 basis point increase, 1 percentage point increase in rates, would add about 164 million euros to the bank's profits. All new loans have rates pegged more closely to the bank's actual cost of funds. Rising interest rates will have another favorable impact on the bank's net worth. The bank is required to calculate its unfunded pension liability and to subtract it from net worth. And it has to be based on the assumption that the related investment portfolio will only achieve a rate of return equal to that of AA rated bonds. Because rates went down so much during the last year or so, the bank took a 1 billion euro paper hit to net worth, even though its actual portfolio went up quite a bit in value. As rates normalize, net worth will be directly enhanced, even though the mark-to-market does not flow through the income statement. Foreign exchange is another issue for the bank. The bank has about half of its balance sheet in England, and it's denominated in sterling, while the Irish assets and liabilities are naturally euro-denominated. The bank has this big balance sheet in England because it has the exclusive banking franchise for the 10,500 branch UK postal system. May seem strange to you that the British have the Irish bank in their postal system, but I think they felt maybe we're a little better run than the postal system. This deal does not involve any fixed overhead, just a commission on volume. And eventually, this UK business will be an excellent business. But for the moment, we have a strange structural problem. The UK branches have generated excessive amounts of deposits relative to the loans, whereas the Irish bank has far more loans than it has deposits. Net result has been a loss in the UK because we have to pay interest on the deposits and then we get less return from UK treasuries. And we've had to do foreign exchange hedges because the bank is ultimately euro denominated. We have about a 40% market share of all the banking business in Ireland, and that helps us to pay 25 or so basis points less on deposit interest rate than the weaker competitors. There's a lady running out to make a deposit in the bank right now. For a while, the other banks were trying to reduce their loan deposit ratio by paying much higher deposit rates than we did, rather than by selling loans. We went the opposite tack. And about a year ago, we brought our ratios down by selling more than 10 billion euros of loans at an 8% discount from par. The other banks are gradually learning that the small amount of incremental deposits they get from paying such a premium deposit rate don't justify paying that premium on all their deposits. Therefore, they have begun to drop their premium deposit rates, and Bank of Ireland is independently following suit. Recently, the ECB has made available to banks a funding mechanism called LTRO. Government agencies love these acronyms, I think because they can't spell long words. It stands for long-term repurchase options. And what it amounts to is collateralized funding at a 75 basis point per annum, 0.75% cost for as long as 3 years. Bank of Ireland has taken down 12.3 billion of LTROs. And the LTRO is a very good example of the dramatic new policies at the European Central Bank. Historically, Europe had always had a German central banker and typically an Italian pope. But until recently, we had a German pope and an Italian central banker. The Pope has resigned for health reasons, but fortunately, the Italian central banker remains in place, and that is good for Europe. It greatly reduces the risk of another pan-European financial crisis, because Mario Draghi clearly is prepared to be the lender of last resort, just like our Federal Reserve Bank is. Can you imagine what would have happened to the U.S. economy during our crisis if Bernanke were not there as the lender of last resort? It would have been horrific. In both cases, the central bank drew a line, saying in effect, the crash stops here, and maintained that policy regardless of how many bonds they had to buy or repo. This puts a pretty high floor under the EU's downside risk. The other risk reduction is what's happening in Greece. Some 2.5 weeks ago, I met with the Prime Minister, his cabinet members, and leading Greek financiers and business people. They're hoping we'll convert from being Irish nationals to being Greek nationals. Mr. Samaras, the Prime Minister, who was elected in June after 2 highly divisive elections, is very impressive. He's a graduate of Harvard and Harvard Business School, has a very good business history, and while his campaign rhetoric was quite leftist, he's not governing that way at all. Instead, he's imposed an unprecedented series of austerity and tax collection measures. A couple of examples. The finance minister appointed by Mr. Samaras used to be the head of Ernst & Young in Greece. The deputy finance minister had been the head of KPMG in Greece, 2 big respected international accounting firms. They now have hired 1,000 forensic accountants, and the job of these fellows is to compare high rollers' tax returns with their bank remittances. And their plan is to pick out a dozen or so, prosecute them, throw them in jail for tax evasion, and hope that that will start to enforce voluntary compliance. If you have any friends there, tell them avoid being the first 12. At the lower level, they're now routinely stopping any fancy new car, checking the registration, and then they compare that to the tax return the owner filed to see whether it's consistent with the filing. Imagine they'll put a few of those people in jail too. So if you're looking for a slightly used Bentley or BMW, Greece may be the place to go. Bank of Ireland became the first Irish bank to re-access the capital markets with a €1 billion 3-year covered bond issue in November at a 270 basis point premium, followed up by 250 million euros of deep Tier 2 capital, and most recently, we arranged for the resale of the 1 billion euros of government-owned Tier 1 contingent convertible notes, or COCOs. All 3 Bank of Ireland issues traded to premiums, and each issue was several times oversubscribed by international investors. The success of these offerings has convinced investors to look again at the bank's stock, driving it to a recent high of 15 euro cents per share. The stock has been very volatile since we bought it, trading as low as 7 cents at the peak of the Greek crisis. Our original cost was 10 cents per share, but we bought more when the stock dropped below 8 cents. We don't believe in the trader's rule, your first loss is your best loss. We think if you're right, you should keep buying it when it goes down. We are now the largest private shareholder by a good bit. Stock, I'm happy to report, closed yesterday at 13.6 cents per share. The Smurfit School of Business in Dublin will soon issue, jointly with the Yale School of Management, a case study of the Bank of Ireland investment. As you may know, Yale has organized a consortium of leading business schools around the world, naturally including Smurfit, to showcase studies, students, and faculty ideas. Bank of Ireland and I are proud to be so showcased. Thank you very much.